What if the difference between retiring anxious and retiring unstoppable came down to 5 decisions you make before 2026? David Tepper didn't build billions by chasing hype. He built them by owning the right assets before everyone else understood their power. Today, I'll show you what to buy before retirement locks your future forever. David Tepper believes wealth isn't about prediction, it's about preparation. As 2026 approaches, markets will reward those who position early, think rationally, and act with conviction. This isn't speculation, it's strategy. In this video, we break down the 5 assets Tepper-style thinkers accumulate before retiring, assets designed to protect capital, generate income, and compound freedom when time matters most. Tepper doesn't buy hope, he buys earnings. That single idea separates speculators from serious wealth builders. Hope is emotional. Earnings are measurable. Before retirement, emotions become expensive and mistakes are harder to recover from, which is why Tepper-style investing focuses on companies that already prove their value every quarter. Earnings are the real scoreboard of business success. They show whether a company can pay its bills, reinvest in growth, reward shareholders, and survive when conditions turn hostile. Hope disappears in downturns. Earnings endure. Dominant companies are not dominant by accident. They earn that position through scale, efficiency, and competitive advantages that are difficult to replicate. These businesses lead their industries not because of hype or temporary trends, because customers depend on them. They control distribution, own valuable brands, or operate networks that competitors can't easily challenge. Before retirement, owning such companies reduces risk because leadership creates resilience. When weaker players struggle, leaders absorb market share, strengthen margins, and emerge even more powerful. Strong cash flow is the lifeblood of this strategy. Cash flow is different from reported profits. It's real money coming in after expenses. Tepper values cash flow because it provides flexibility. Companies with steady cash flow can survive recessions without begging for capital. They can pay dividends, buy back shares, reduce debt, or invest aggressively when others are forced to retreat. For a retiree or near-retiree, cash flow generating businesses act like financial shock absorbers. They soften volatility and provide stability when markets swing violently. Pricing power is another non-negotiable trait. Tepper understands that inflation is one of the greatest threats to long-term wealth, especially near retirement. Companies with pricing power can raise prices without losing customers. This protects margins even when costs rise. Businesses without pricing power get crushed during inflationary periods because expenses increase while revenues lag. Owning companies that can pass costs on to consumers means your capital stays protected in real terms, not just on paper. A strong balance sheet ties everything together. Tepper avoids companies drowning in debt because leverage magnifies risk during downturns. Strong balance sheets provide freedom. Low debt, ample liquidity, and smart capital allocation allow companies to endure economic stress without dilution or bankruptcy risk. When credit tightens, financially healthy companies don't panic, they negotiate from strength. Before retirement, this matters more than chasing fast growth. Survival and stability come first. This is why Tepper views volatility as noise. Price swings reflect fear, headlines, and short-term sentiment, not business reality. Fundamentals, on the other hand, reflect long-term truth. Earnings, cash flow, pricing power, and balance sheet strength don't change overnight. Investors who understand this stop reacting emotionally to market drops. Instead, they see volatility as an opportunity to accumulate stronger positions at discounted prices. In the end, Tepper's philosophy is about certainty in an uncertain world. Before retirement, the goal isn't excitement, it's confidence. Owning businesses built on real earnings replaces anxiety with discipline. When markets fall, hope-based investments collapse. Earnings-based investments endure, recover, and compound. That's how wealth survives recessions, thrives in recoveries, and delivers freedom when time becomes the most valuable asset of all. Retirement isn't about selling assets, it's about owning cash machines. That idea flips the traditional retirement mindset on its head. Many people believe retirement means slowly liquidating what they've built, watching account balances shrink as they fund their lifestyle. David Tepper's way of thinking is the opposite. True retirement strength comes from owning assets that continue to produce income on their own without forcing you to sell at the wrong time. When markets are volatile, selling assets becomes risky and emotional. Cash-generating investments remove that pressure by paying you regardless of market mood. Tepper respects income streams that grow over time because growth is what protects dignity in retirement. Inflation doesn't stop when you stop working. Prices rise every year, silently eroding purchasing power. Fixed income may feel safe, but its biggest weakness is stagnation. A bond paying the same amount year after year slowly loses real value. Dividend-growing companies, on the other hand, increase what they pay as their earnings grow. That rising income keeps pace with inflation and often surpasses it, preserving lifestyle rather than slowly shrinking it. Dividend growers succeed because they are built on strong businesses, not financial engineering. Companies that can consistently raise dividends must have reliable earnings, disciplined management, and durable competitive advantages. Tepper values this discipline. Management teams that commit to growing dividends are forced to think long-term. They can't gamble recklessly, because cutting a dividend damages credibility. This creates alignment between the company and the investor, especially for those approaching retirement who value stability over speculation. Another advantage of dividend growth is psychological. During market downturns, price volatility can create fear, even when fundamentals remain strong. Growing dividends shift the focus from daily price movements to ongoing income. When your income keeps rising, market drops feel less threatening. You're not dependent on selling shares to survive, you're being paid to hold. Tepper understands that emotional control is a competitive edge, and dividend income provides that control when it matters most. Over long periods, dividend growers often outperform fixed income because they compound. A growing dividend reinvested during accumulation years buys more shares, which then generate even more income. By the time retirement arrives, the income stream is larger, more resilient and self-sustaining. Fixed income doesn't compound the same way. Once purchased, its return is largely capped. Dividend growth has no such ceiling as long as the underlying business continues to expand. Tepper also recognizes flexibility as a hidden benefit. Dividend-paying equities provide income today and growth tomorrow. They can adapt to changing economic environments, unlike many fixed income instruments locked into fixed payments. When interest rates rise or fall, dividend growers adjust through earnings, pricing power, and expansion. This adaptability makes them especially valuable heading into retirement. When long-term certainty is rare, ultimately Tepper's respect for dividend growth is about control. Retirement should not feel fragile or reactive. It should feel stable, deliberate, and calm. Owning cash machines that pay you more each year replaces dependence with independence. Instead of hoping markets cooperate, you rely on businesses that reward patience. That is why dividend growers over time beat fixed income, not just in returns, but in confidence, resilience, and lasting financial freedom. Tepper is famous for buying when others panic because he understands a truth most investors ignore: fear creates mispricing. Markets don't collapse because value disappears overnight. They fall because emotion overwhelms logic. Bonds are one of the clearest places where this happens. When fear rises, whether from inflation scares, rate hikes, recessions, or geopolitical shocks, bond prices often drop sharply as yields spike. Most investors see falling prices and rush for the exit. Tepper sees something different, improving future returns. Before 2026, smart retirees don't avoid bonds altogether, and they don't blindly buy them either. They position selectively with patience and discipline. Bonds are not about excitement, they are about timing and structure. When yields are low, bonds offer little protection and limited upside. But when fear pushes yields higher, bonds quietly become attractive again. Higher yields mean more income and greater potential for price appreciation if conditions normalize. That's where opportunity lies. The relationship between interest rates and bond prices is simple but powerful. When rates rise, bond prices fall. When rates fall, bond prices rise. Tepper uses this math unemotionally. He doesn't guess the exact peak in rates, he watches sentiment. When headlines are filled with pessimism and investors are convinced rates will stay high forever, that's often when yields already reflect worst-case scenarios. Buying bonds at those moments locks in elevated income and positions the investor for capital gains when fear fades. For retirees, this strategy matters because it restores balance to a portfolio. Equities drive long-term growth, but bonds provide stability and predictability. When purchased at the wrong time, bonds feel like dead weight. When purchased during panic, they become shock absorbers. As economic stress eases and rates decline, bond prices rise, often at the same time equities are struggling. That inverse behavior smooths returns and reduces the need to sell stocks during downturns. Tepper's discipline is what separates success from regret. Buying bonds when yields spike feels uncomfortable. It goes against recent experience and popular opinion. But discipline means acting on probabilities, not emotions. High yields already compensate investors for risk. Waiting for clarity usually means paying higher prices and accepting lower returns. Tepper doesn't wait for comfort, he waits for opportunity. Selective positioning is key. Not all bonds are equal. Quality matters, especially near retirement. Strong issuers, reasonable duration, and clear understanding of risk are essential. Tepper avoids chasing yield blindly. He looks for situations where fear has pushed prices below intrinsic value, not where risk is permanently impaired. This approach protects capital while still allowing upside. As rates eventually fall, whether due to slowing growth, easing inflation, or policy shifts, those disciplined bond purchases are rewarded. Income continues to flow and prices rise, often unexpectedly. What once felt risky becomes a stabilizing force. That's the payoff for acting when others hesitated. In the end, Tepper's bond strategy isn't about predicting the future, it's about preparing for it. Fear-driven markets offer rare chances to lock in attractive returns with relatively low risk. Before 2026, retirees who understand this won't fear bonds, they'll respect them. And when discipline replaces panic, patience turns into profit. Inflation silently steals retirement because it works in the background, unnoticed at first, but devastating over time. Unlike market crashes, inflation doesn't announce itself with panic. It erodes purchasing power year after year. What feels comfortable today can become insufficient a decade later. David Tepper understands that this slow erosion is one of the greatest threats to long-term wealth, especially for retirees who no longer have active income to offset rising costs. Tepper-style thinking doesn't ignore inflation or hope it disappears. It plans for it deliberately. Protection begins with understanding that paper money weakens over time. Cash and fixed payments lose value as prices rise, even if account balances look unchanged. That's why Tepper favors assets tied to real economic activity, things the world actually uses and depends on. Infrastructure, energy, and real estate-linked investments are not abstract financial instruments. They are embedded in daily life, and their value adjusts as the cost of living increases. When money weakens, real assets tend to reprice upward. Infrastructure is a prime example. Roads, utilities, ports, pipelines, and communication networks are essential regardless of economic conditions. These assets often operate under long-term contracts or regulated frameworks that allow pricing to rise with inflation. Users pay more over time because they must keep using the service. For retirees, this creates a rare combination of stability and inflation protection. Cash flows tend to be steady, and income often grows as costs rise, preserving real purchasing power. Energy exposure plays a similar role. Energy is not optional. It powers economies. When inflation rises, energy prices often rise with it because energy sits at the foundation of production and transportation. Companies and assets connected to energy production, distribution, and infrastructure tend to benefit from higher pricing environments. Tepper understands that energy isn't just a commodity trade, it's a strategic hedge against inflation's impact on daily expenses. When energy costs rise, owning exposure offsets the pain felt elsewhere. Real estate-linked investments also serve as powerful inflation shields. Property values and rents tend to rise over time as replacement costs increase. Land, buildings, and physical space are finite, and demand doesn't disappear. Rental income often resets higher, keeping pace with inflation in ways fixed payments cannot. Tepper doesn't see real estate purely as speculation. He sees it as ownership of scarce, productive assets that generate income while adjusting to economic reality. What unites all these assets is their connection to real demand. They aren't dependent on optimism or financial engineering. People need electricity, transportation, housing, and energy regardless of market cycles. That demand gives these assets pricing power, the ability to pass rising costs on to users. Pricing power is inflation's natural enemy. Without it, wealth slowly erodes, even in seemingly safe portfolios. Tepper-style thinking emphasizes balance, not extremes. Inflation protection doesn't mean abandoning traditional investments or chasing trends. It means layering protection intelligently. Real assets provide diversification and stability when paper assets struggle. They don't eliminate risk, but they change its nature, anchoring portfolios in tangible value. Ultimately, protecting against inflation is about preserving freedom. Retirement should not feel like a constant trade off between comfort and caution. By owning assets tied to real economic activity, retirees defend their purchasing power and their peace of mind. Inflation may be silent, but preparation speaks loudly. And those who plan with Tepper's discipline don't just survive inflation. They outlast it. Cash isn't lazy, it's strategic. Most investors view cash as inert, something that sits idly in a bank account, earning little while inflation quietly erodes its value. David Tepper thinks differently. He treats cash as a weapon, a tool that provides unmatched flexibility in turbulent markets. Cash doesn't generate spectacular returns on its own, but its true value comes from the opportunities it creates and the control it provides. Before retirement, understanding the strategic power of cash can be the difference between watching others accumulate wealth and being able to act decisively when rare opportunities arise. Tepper keeps what he calls dry powder for moments of chaos, periods when fear grips markets and asset prices collapse. In these moments, most investors panic and sell. Locking in losses, Tepper sees the same events as the ideal time to acquire high-quality assets at prices that are far below their intrinsic value. Owning cash during these periods allows him to act without hesitation. Before retirement, having liquidity provides the same advantage. Instead of being forced to sell stocks or bonds at unfavorable prices to meet expenses, you can patiently wait for opportunities to acquire assets that will deliver long-term growth and income. Cash also offers unparalleled control. When your portfolio is fully invested, every decision is reactive. A sudden market downturn forces you to adjust holdings under pressure, often at a loss. Tepper understands that true control comes from having options. Cash gives you the choice to act rather than react, to select the best investments rather than the only available ones. Before retirement, this level of control is crucial. You want your money working for you, not you working for market conditions. Flexibility is another key benefit. Retirement planning requires both security and adaptability. Life is unpredictable, and markets are cyclical. Cash allows you to navigate these cycles without panic. When interest rates spike, when inflation rises, or when equity markets tumble, having cash enables you to take advantage of shifts rather than suffer from them. Tepper uses cash to pivot quickly, buying undervalued assets, increasing exposure to opportunities, or holding back to protect capital when conditions are uncertain. For retirees or near retirees, this flexibility is a form of insurance that goes beyond traditional policies. Moreover, cash allows for patience, which is one of the most underrated virtues in wealth accumulation. Tepper doesn't rush into every trade or investment. He waits for the right moment. Before retirement, having cash means you can wait for markets to overshoot in panic, for valuations to fall, and for fear to create bargains. This patience transforms cash from a seemingly dormant asset into a powerful generator of wealth, because it enables the purchase of high-quality assets at terrible prices that often become historically profitable once the panic subsides. In essence, cash is not just a fallback. It is a tool for opportunity, security, and control. Tepper's philosophy teaches that wealth is not just built by buying the right assets, but by having the means to buy them when others cannot. Before retirement, cash ensures you remain in command of your financial destiny. It turns volatility into opportunity, fear into advantage, and scarcity into power. Those who understand this see cash not as idle money, but as one of the most strategic assets they can hold, a weapon that, when used wisely, multiplies their ability to grow and preserve wealth. Tepper concentrates when conviction is high because he knows that spreading capital too thin is a silent killer of wealth. Many investors fall into the trap of over-diversification, believing that owning dozens of assets automatically reduces risk. In reality, over-diversification dilutes returns, masks mistakes, and creates complexity that makes it difficult to respond quickly when opportunities arise. David Tepper's approach is the opposite. He invests with clarity, discipline, and purpose, focusing on areas where he has deep understanding and confidence. Before retirement, this principle becomes even more critical. When time to recover from mistakes is limited, every dollar must work efficiently, not scatter across marginal opportunities. Concentration requires conviction. Tepper doesn't buy an asset simply because it is popular or because someone recommends it. He invests where he sees clear value, strong fundamentals, and long-term growth potential. Each position is deliberate, supported by analysis and confidence in the business model. Retirement portfolios should adopt the same mindset. A focused portfolio allows retirees to monitor positions closely, understand their risks, and make informed decisions without the distraction of numerous mediocre holdings. Fewer assets, when chosen wisely, can outperform a heavily diversified portfolio, especially over decades when compounding works its magic. Intentionality is key. Every investment should have a purpose within the portfolio. Tepper asks hard questions before committing capital. Why am I buying this? What problem does it solve? What upside exists? How does it behave in stress scenarios? If the answers aren't clear, the investment is often abandoned. Retirement portfolios should follow the same logic. Owning an asset simply because it's trendy or because everyone else adds little to long-term security. Intentional investing prioritizes assets that align with objectives, growth, income, inflation protection, or capital preservation, rather than filling a portfolio with noise. Understandability is equally important. Tepper famously avoids businesses or investments he cannot fully grasp. Complexity increases risk. If you don't understand how an asset makes money, how it reacts to economic cycles, or what factors drive its value, you're essentially gambling with your retirement. Focused portfolios ensure that every asset can be explained simply and confidently. This transparency allows retirees to react appropriately to market changes, understand the rationale behind returns, and communicate their strategy clearly to advisors or family members. Concentration also leverages compounding. Tepper doesn't just invest in high-conviction ideas, he doubles down when conditions are favorable. This approach magnifies returns without increasing exposure to unknown risks. Retirement portfolios benefit from the same strategy by allocating more to the best opportunities. Retirees can accelerate wealth growth while maintaining a manageable level of risk. Over time, the power of focused compounding can dramatically enhance financial security far more than a fragmented portfolio filled with average performing assets. Ultimately, Tepper's philosophy teaches that less can be more. Retirement success is not about chasing every opportunity, but about holding the right ones with discipline, clarity, and confidence. Concentration turns understanding into action, conviction into results, and focus into long-term freedom. If you cannot explain why you own an asset, it likely doesn't belong in your portfolio. By keeping investments focused, intentional, and understandable, retirees position themselves to maximize returns, minimize stress, and preserve capital for the years that matter most. Markets move in cycles, and understanding this is one of the cornerstones of Tepper-style investing. Many investors approach markets as if they move in straight lines, expecting growth to continue indefinitely or fearing every downturn as catastrophic. David Tepper sees the world differently. He recognizes that economic expansions, contractions, booms, and recessions are natural and recurring. Markets are not random. They follow patterns influenced by human behavior, policy decisions, and fundamental economic forces. Before 2026, retirees and near retirees must grasp this truth: cycles don't destroy wealth. Ignorance does. Failing to understand where we are in the broader cycle leaves investors vulnerable to emotional decision-making, panic selling, and missed opportunities. Studying cycles relentlessly is what separates disciplined investors from speculators. Tepper doesn't rely on guesswork or wishful thinking. He analyzes data, economic indicators, interest rate trends, corporate earnings, and market sentiment to understand the stage of the cycle. This isn't about predicting the exact top or bottom. It's about positioning capital with a probabilistic understanding of risk and opportunity. Before retirement, adopting this mindset is crucial. When you know the general trajectory of the cycle, you can make rational choices, whether that means increasing exposure to growth assets during recovery phases or shifting to defensive positions during slowdowns. Emotional reactions, by contrast, often result in buying high out of greed and selling low out of fear, the opposite of what creates long-term security. Cycles affect every asset class. Stocks rise and fall, bonds respond to interest rate changes, commodities fluctuate with supply and demand, and real estate moves in response to economic growth and borrowing costs. Tepper's mastery lies in recognizing how each asset behaves relative to the cycle. Before 2026, retirees who understand cycles can anticipate potential shifts and allocate their portfolios more effectively. This doesn't mean attempting to time every move perfectly. It means creating a framework where each decision is informed by the stage of the cycle, reducing the likelihood of panic mistakes when markets inevitably wobble. Ignorance, not cycles, destroys wealth. Investors who fail to recognize patterns often interpret normal downturns as catastrophic and normal recoveries as fleeting. They overreact, liquidate assets at the wrong time, or avoid opportunities entirely. Tepper's approach is grounded in rationality. Acknowledge that cycles exist, accept that volatility is normal, and focus on fundamentals rather than fear or hype. Understanding cycles allows you to see market drops not as threats but as potential opportunities to acquire high-quality assets at attractive valuations. Similarly, recognizing expansion phases can help in capturing growth before valuations become excessive. Before 2026, cultivating this awareness is more important than ever. Economic environments are shifting, interest rates are changing, and geopolitical events add complexity. Investors who react emotionally to every headline will likely compromise their retirement security. Those who study cycles, as Tepper does, create a buffer against uncertainty. They make decisions informed by data, probabilities, and historical patterns rather than panic. Ultimately, the lesson is simple but powerful. Markets move in cycles, and knowledge of those cycles provides clarity, control, and confidence. Ignorance of cycles leads to mistakes, stress, and lost wealth. By studying cycles relentlessly, understanding economic positioning, and separating emotion from analysis, retirees can navigate market volatility, seize opportunities, and preserve capital. Tepper's philosophy teaches that preparation and understanding, not fear, determine long-term financial success. Tepper's first rule is survival, and it is perhaps the most important principle for anyone approaching retirement. Many investors focus obsessively on chasing the highest returns, believing that bigger gains automatically translate into greater wealth. While returns matter, Tepper understands that they are meaningless if the portfolio cannot survive market turbulence. Protecting the downside is the foundation of long-term financial success because losses are not easily reversed, especially as time becomes a more precious asset. Retirement isn't about outpacing the market in good times. It's about enduring the bad times without permanent damage. If you survive, the upside eventually takes care of itself, thanks to the power of compounding over years or decades. Downside protection begins with a disciplined approach to risk management. Tepper avoids positions that could jeopardize his capital, even if they promise outsized returns. This principle applies directly to retirement planning. Nearing or in retirement, you don't have decades to recover from mistakes. A portfolio designed without a focus on survival is fragile. A severe market downturn can derail years of careful planning. By prioritizing downside protection, retirees preserve the ability to compound returns over time. Compounding works best when capital remains intact. Losing a significant portion of a portfolio early on dramatically slows growth and in some cases may never fully recover. Diversification and quality play a key role in protecting downside. Tepper concentrates where conviction is high, but also ensures that each position is robust, with strong fundamentals, resilient cash flow, and a proven business model. This principle translates to retirement investing as well. Instead of chasing risky fads or speculative investments, retirees should focus on assets that can weather economic storms. Companies with strong balance sheets, real assets that maintain intrinsic value, and cash-generating investments like dividend growers or carefully selected bonds act as buffers during turbulent periods. They reduce vulnerability and ensure that losses are minimized when the market turns against you. Patience and discipline amplify the benefits of survival-focused investing. Tepper waits for the right opportunities, never feeling pressured to act impulsively. By surviving market fluctuations, he positions himself to take advantage of undervalued assets during times of fear or uncertainty. Similarly, retirees who prioritize capital preservation create optionality. When markets drop, they can invest strategically rather than being forced to sell at a loss. When markets recover, their preserved capital participates fully in the upside. Survival, in this sense, is not passive. It is an active strategy that allows investors to stay in the game and reap compounding rewards over time. Psychology is also critical to survival. Tepper recognizes that fear and greed are the primary threats to long-term wealth. Emotional decision-making leads to selling low during panic or buying high during euphoria. Protecting downside requires not only robust assets, but also a mindset that resists impulsive reactions. Retirement success is about maintaining composure, making rational decisions, and letting time and discipline do the work. Ultimately, Tepper's philosophy teaches that survival is the foundation of wealth. Retirement isn't about chasing the highest possible return in every market cycle. It's about ensuring that your capital endures long enough to compound, grow, and provide security. Protecting the downside preserves opportunity, flexibility, and peace of mind. When survival is prioritized, the upside naturally follows. It is the combination of prudence, discipline, and patience that transforms wealth from fragile hope into lasting financial freedom. Tepper adapts fast. He doesn't marry opinions. That flexibility is one of the hallmarks of his success and a principle that becomes essential as investors approach retirement. Many people cling to a single worldview or investment thesis, unwilling to adjust even when evidence suggests the environment has changed. Tepper recognizes that markets, economies, and interest rates are dynamic. Fixed strategies fail when conditions shift, but adaptable strategies thrive. Before retirement, the stakes are even higher. You can't afford to lock your portfolio into rigid assumptions because mistakes become harder to recover from and time to regain lost wealth is limited. Flexibility, therefore, is not a luxury, it is a necessity. Building a portfolio that can adjust to inflation, deflation, growth, or recession begins with understanding that certainty is expensive. Investors who try to predict the perfect path often a premium for it, buying assets that seem safe under one scenario but fail when conditions deviate. Tepper avoids this trap by focusing on adaptable investments. Before retirement, this means selecting assets that respond differently across economic cycles, creating a balance that can withstand shocks. For example, Dividend, growing stocks can provide income during slow growth. Real assets and infrastructure can hedge against inflation, while high-quality bonds and cash give protection during deflationary periods. Flexibility in allocation ensures that the portfolio can shift when conditions change, rather than being trapped in a single outcome. Tepper's approach also emphasizes speed and adaptation. He doesn't debate endlessly or cling to ideology when the market sends new signals. Before retirement, investors need a similar mindset. Economic indicators, interest rate trends, corporate earnings reports, and geopolitical developments should inform decisions. A rigid portfolio ignores these signs. A flexible portfolio reacts rationally, repositioning capital toward opportunities or defensive positions as necessary. Flexibility allows retirees to protect wealth during crisis and capitalize on dislocations when fear pushes prices below intrinsic value. Diversification alone is not enough. It must be paired with adaptability. Tepper doesn't simply spread investments widely and hope for stability. He allocates with intention, selecting assets that complement each other under varying economic conditions. Before retirement, this means building a portfolio that is robust, not by sheer number of holdings, but by the diversity of responses to economic scenarios. This kind of structure ensures resilience. When growth stalls, income-generating assets keep cash flowing. When inflation rises, real assets preserve purchasing power. When interest rates fall, bonds appreciate. Each component has a role depending on the environment, and the portfolio as a whole adjusts automatically to shifting conditions. Flexibility also requires a disciplined mindset. Tepper adapts because he observes, analyzes, and acts rather than reacting emotionally. Retirement success demands the same composure. Markets are unpredictable, and conditions will never match anyone's expectations perfectly. By remaining open to new data, reevaluating assumptions, and adjusting allocations accordingly, retirees maintain control and preserve optionality. Flexibility turns uncertainty into opportunity and reduces the risk that a single market event can derail years of planning. Ultimately, Tepper's philosophy teaches that rigidity is costly, while flexibility is priceless. A portfolio that can adapt to inflation, deflation, growth, or recession does more than survive. It positions wealth to thrive. Before retirement, adaptability ensures that your assets are prepared for any eventuality, giving you both protection and the freedom to seize opportunity when others panic. The ability to adjust quickly without ego or attachment transforms uncertainty from a threat into a strategic advantage, securing long-term financial freedom. The greatest asset Tepper owns isn't stock or bonds, it's discipline. Many investors search for the next big opportunity, the market's perfect trade, or a magical shortcut to wealth. But Tepper understands that lasting success isn't built on luck or prediction. It's built on consistent, disciplined behavior. Discipline is what allows him to act decisively when others panic, to stay patient when markets fluctuate, and to prepare thoroughly before committing capital. Before retirement, discipline becomes far more important than individual market calls because the ability to manage emotions, exercise patience, and act rationally directly determines long-term outcomes. Emotional control is a cornerstone of Tepper's discipline. Markets are volatile, and headlines are designed to provoke fear and greed. Most investors react impulsively, buying high during euphoric rallies and selling low during panics. Tepper recognizes that emotional reactions are often the biggest risk, far outweighing market risk itself. Before retirement, maintaining emotional composure is critical. A single irrational decision, selling in a downturn or chasing a fad, can have decades-long consequences. Discipline allows retirees to remain calm during crisis, to evaluate opportunities logically, and to make decisions based on strategy rather than sentiment. Emotional control transforms uncertainty from a threat into an advantage, allowing disciplined investors to capitalize when fear drives others to mistakes. Patience is another key component. Tepper doesn't chase quick gains. He waits for the right opportunities. Before retirement, time becomes both an ally and a limitation. Patience allows investors to let investments compound, to ride out temporary volatility, and to avoid the destructive impulse to act prematurely. Many retirees underestimate the power of compounding, assuming that returns must be aggressive to be meaningful. Tepper's approach demonstrates that disciplined patience, allowing quality assets to grow steadily over years, creates far more reliable wealth than chasing short-term gains. The ability to wait even when the market tempts you to move is a skill that compounds just like capital. Preparation is equally critical. Tepper studies markets, companies, and economic cycles relentlessly. He doesn't make decisions based on guesswork or rumors. Before retirement, preparation ensures that every investment is informed by data, analysis, and careful thought. Prepared investors enter markets with a plan, understand the risks involved, and know when to act or when to hold back. This forethought prevents costly mistakes and allows opportunities to be seized with confidence. Discipline is useless without preparation. Together, they create a framework for rational decision-making under pressure. Ultimately, discipline governs how capital is deployed, preserved, and grown. Stocks, bonds, and real assets are tools, but without the mindset to manage them effectively, they cannot achieve their potential. Tepper's discipline allows him to survive downturns, exploit opportunities, and consistently outperform over time. Before retirement, this is the single most valuable asset a person can cultivate. It determines whether wealth is preserved, eroded, or multiplied. In the end, discipline is what separates those who merely hope for a comfortable retirement from those who achieve one. Emotional control, patience, and preparation shape every decision, safeguard capital, and enable strategic action. While markets are unpredictable, disciplined investors are not at the mercy of events. They respond thoughtfully, consistently, and effectively. Tepper's greatest asset proves that mindset, more than timing or speculation, decides retirement outcomes, turning preparation and composure into long-term financial freedom.